China's $38,000 gold target and July 24th market shakeup, a hidden bullish message. There's a date circled on the calendars of central bankers, hedge fund managers, and gold analysts around the world, July 24th. On that day, something changes in China, quietly, without fanfare, but with consequences that could ripple through every gold and silver market on Earth. Some say it's the start of the biggest wealth transfer in a generation. Others say it's a warning sign of something far more dangerous underneath the surface of the global economy. By the end of this video, you will understand exactly what is happening and why the next 5 days may matter more than the last 5 years. Welcome back to Precious Metals Intelligence. If you're new here, this channel exists for one reason: to help thoughtful, serious people understand what is really happening beneath the surface of the global economy, without the noise, without the hype. If that sounds like the kind of clarity you value, consider joining the community by subscribing. It costs nothing, and it means you won't miss the next piece of this story when it unfolds. And before we begin, we'd genuinely love to know, where in the world are you watching from today? Drop your city or country in the comments. This channel has viewers across dozens of countries, and it's always remarkable to see just how global this conversation about wealth and economic security really is. For most of the year, July 24th looked like an ordinary day. No holiday, no major election, no scheduled meeting of the Federal Reserve. And yet, in gold and silver trading circles, this single date has become something close to a countdown. To understand why, one has to look at what is actually happening in China. Several of the country's largest banks are ending a specific kind of service. They are stopping regular people from trading leveraged paper gold contracts. In simple terms, this means ordinary Chinese investors will no longer be able to bet on gold prices using borrowed money through these bank platforms. They will still be able to buy real, physical gold. They will still be able to buy gold funds that trade on the stock market. What is closing is just one narrow door, the paper contract door, not the entire market. This is an important distinction, because online the story has grown far beyond the facts. Some content creators are calling this an outright ban on gold trading in China. Others are calling it the start of a new global gold order. Neither claim is accurate. What is happening is more limited, more procedural, and frankly, less dramatic than the headlines suggest. But here is why serious investors are still paying attention. Even a small procedural change like this can create real pressure in the market. Here is how. Right now, most people trading gold through these Chinese bank platforms are betting that prices will rise. This is called being a net long. When banks shut down access to these contracts, all of those existing bets do not simply disappear. They must be closed out. Some investors will convert their position into physical gold. Others will simply exit the market and take their money elsewhere. Either way, a large number of trades will unwind around the same time. When many trades unwind at once, it can cause short-term price swings. This is not a theory. It has happened before in other markets under similar conditions. So the concern is reasonable. The question is not whether this creates pressure. It likely will to some degree. The real question is how much pressure and for how long. This is where careful analysis matters more than speculation. Some analysts believe most of the selling has already happened. They point to the fact that trading costs on these gold contracts have been rising for months, which has already pushed many smaller investors out of the market ahead of the official deadline. If that is true, then July 24th may end up being less of a shock and more of a formality, the final step in a process that has been unfolding quietly for weeks. Other analysts disagree. They believe the bigger move is still ahead. They point to how much gold China has been importing recently and how much the country's central bank has been buying. To them, this suggests China is preparing for a much larger shift, not just closing a small trading window. Both views cannot be fully correct, but both are worth understanding, because they represent two different pictures of how seriously to take this date. One picture is calm and gradual, the other is urgent and disruptive. The truth may end up sitting somewhere between the two. What makes this story genuinely interesting is not the date itself, it is what the date represents. China is not simply changing a banking policy. It is making a quiet decision about how much control it wants over the direction of the gold market. For decades, much of the world's gold trading has moved through paper contracts, priced and settled far away from any physical metal changing hands. If China is nudging its own citizens away from paper and toward physical ownership, even in a small way, that decision carries meaning beyond its own borders. This is why business professionals and long-term investors are watching closely, even though most people outside the metals market have never heard of this deadline. It is not about one single day causing a dramatic event. It is about what this day may reveal, about China's intentions, about investor behavior, and about how fragile or how strong the current gold market actually is underneath the surface. In the next part, the focus shifts to a bigger question. Why has China been buying so much gold in the first place? And what does that buying pattern say about the country's long-term plans for the US dollar, global trade, and its own economic independence? Numbers rarely lie, even when the reasons behind them are debated. And one number has been quietly climbing for years: the amount of gold sitting inside China's central bank vaults. This did not happen overnight. China's central bank has been adding gold to its reserves on a fairly consistent basis for close to 2 decades, with the pace picking up noticeably in recent years. Some months, the buying slows. Other months, like this past June, it jumps sharply. But the overall direction has stayed the same: more gold year after year, sitting quietly on the balance sheet. To understand why, it helps to step back from gold itself and look at something bigger: how countries pay each other for goods. For decades, the vast majority of global trade has been settled in US dollars. A factory in one country sells goods to a buyer in another country, and the payment moves in dollars, even if neither country is the United States. The system has given the US dollar enormous influence. It also means that other countries, including China, must hold large amounts of US dollars and US government debt simply to keep their trade running smoothly. But holding another country's currency in massive quantities comes with a risk. That currency can lose value. It can be affected by decisions made entirely outside your own borders: interest rate changes, government spending, political disputes. For a country like China, which runs a large trade surplus and therefore accumulates dollars steadily, this risk is not small. It is structural. Gold offers a different kind of asset. It is not issued by any government. It cannot be printed. No single country controls its supply. For a nation looking to reduce its dependence on any one currency, gold becomes an obvious tool, not because it is exciting, but because it is neutral. This is the real story behind China's gold buying. It is not a single dramatic decision. It is a slow, steady diversification strategy, similar to what a careful investor might do with a retirement account. Reduce concentration in one asset. Spread the risk. Build a cushion that does not depend on any other country's policy choices. China is not alone in this. Central banks around the world, particularly in emerging economies, have been buying gold at a pace not seen in decades. Some of these countries have openly discussed reducing reliance on the US dollar for trade settlement. Others have simply increased their gold reserves without much public explanation at all. Either way, the pattern is consistent, and it has been building for years, long before anyone was talking about July 24th. This broader trend matters because it gives context to the more specific story about paper gold trading in China. A single policy change affecting retail investors is a small event on its own. But when it happens inside a country that has spent years quietly reducing its dependence on the dollar and increasing its physical gold holdings, that small event starts to look like one more piece of a much larger picture. It is worth being careful here, though. Wanting more gold reserves is not the same as wanting a specific gold price. A central bank can value gold as a stable, neutral reserve asset without needing or expecting its price to reach any particular number. The motivation is about reducing risk and increasing independence, not about hitting a price target for its own sake. This distinction becomes important later in this video when the conversation turns to a very specific number that has been circulating online: $38,000 an ounce. That number comes from a mathematical exercise, not from any official Chinese policy statement. Understanding China's actual documented behavior, steady buying, dollar diversification, reduced reliance on paper markets, helps separate what is real from what is speculation. For now, the key point is this: China's gold buying is not new, and it is not a secret. It has been visible in public data for years. What is new is the growing attention being paid to it, especially as more people start asking what a shift this size might eventually mean for the price of gold itself, and for anyone holding it. In the next part, that exact question comes into focus. Where does the $38,000 figure actually come from? And does the math behind it hold up to scrutiny? Every so often, a number appears online that is so large, so shocking, that it spreads faster than anyone can explain it properly. $38,000 an ounce is one of those numbers. To put that in perspective, gold has spent most of its history trading nowhere close to that level. Even during its strongest recent years, it has moved in the thousands, not the tens of thousands. So when a figure like this starts circulating, the natural reaction is disbelief, followed by curiosity. Where did this number come from, and is there any real math behind it? The answer is yes, there is math. But the math is not a prediction. It is a theory, built on a specific way of thinking about trade and gold that most people have never been taught. Here's the basic idea. Every year, China sells far more goods to the rest of the world than it buys back. This difference is called a trade surplus. In recent years, that surplus has been enormous, often exceeding $1 trillion. At the same time, China imports a certain amount of physical gold into the country every year, measured in metric tons. The theory behind the $38,000 figure takes these two numbers and divides one by the other. It asks a simple question: If China wanted to fully back its trade surplus with the gold it imports, meaning if every dollar of that surplus were represented by an equivalent value in gold, what price would gold need to reach to make the math work? When someone runs that calculation using recent trade and import figures, the result lands somewhere around $38,000 an ounce. That is where the number comes from. It is not a government target. It is not a forecast from a bank or an economist predicting where prices are headed next year. It is a hypothetical valuation built entirely on the assumption that gold would need to fully offset a specific trade imbalance. This kind of exercise has a name in economics. It is sometimes called a fair value model or a shadow price. These models exist for many assets, not just gold. They ask, in effect, what would this asset be worth under a very different set of rules than the ones we actually live under today? They can be useful for thinking clearly about long-term imbalances, but they are not designed to predict short-term prices, and they should never be treated as a certainty. It helps to compare this to something more familiar. Imagine someone calculates that a small house, based purely on the cost of land, labor, and materials, should theoretically be worth $1 million. That number might be mathematically defensible, but the actual house may still sell for $300,000 tomorrow because real markets are shaped by far more than one clean formula. Buyers, sellers, confidence, timing, and dozens of other forces all play a role. Gold works the same way. Its price is not set by a single equation. It is set by millions of buyers and sellers every day, responding to interest rates, currency movements, investor sentiment, and countless other factors that no formula can fully capture. This does not mean the $38,000 calculation is meaningless. It simply means it should be understood for what it is, an interesting thought experiment about trade and monetary imbalance, not a countdown to a specific price by a specific date. This distinction matters enormously for anyone trying to make real decisions with real money. Confusing a theoretical valuation model with a short-term price forecast can lead to disappointment or worse, poor financial choices made in anticipation of something that was never actually promised to happen. A serious investor can appreciate the thinking behind a model like this while still asking hard questions about whether the assumptions hold up in the real world. So where does that leave the story? China's gold buying is real and well documented. Its efforts to reduce dependence on the US dollar are real and consistent with public data. But the $38,000 figure is neither official policy nor a near-term forecast. It is a calculation built on assumptions, describing what gold could theoretically be worth under a very specific and, for now, hypothetical scenario. In the next part, the focus shifts away from theory and back toward the present moment, to the real tension currently playing out in the gold and silver markets between short-term selling pressure and long-term supply tightening, and why both forces may be true at exactly the same time. Every market conversation eventually arrives at one practical question. Is this good news or bad news for the price? With the July 24th story, the honest answer is both, and understanding why requires looking at two separate timeframes at once. Start with the bearish case, because it is the more immediate one. When large Chinese banks close access to leveraged paper gold trading, every existing position built on that system has to go somewhere. Some investors will convert their exposure into physical metal. Others will simply close their trades and walk away. In a market where most participants have been betting on rising prices, this creates a wave of selling pressure concentrated around the same period of time. That kind of concentrated unwinding can push prices down in the short term, sometimes sharply, even if nothing has fundamentally changed about gold's long-term value. This is not a controversial idea. It has happened in other markets, under other circumstances, many times before. When a large group of similar bets gets forced to close at once, prices tend to move against those positions before they stabilize again. Anyone who has watched a market unwind a crowded trade knows how disorderly that process can look while it is happening. But there is a case on the other side, and it deserves equal attention. A growing number of analysts argue that most of this unwinding has already happened. Their reasoning is straightforward. The cost of holding these leveraged gold contracts has been rising for months, well before any official deadline arrived. Rising costs tend to push out weaker, more leveraged positions first, gradually rather than all at once. If that process has already been underway, then July 24th may not trigger a fresh wave of selling. It may simply confirm a shift that has already occurred quietly, in stages, out of the spotlight. Then there's the longer-term argument, which looks past the immediate weeks entirely. Regardless of how the short-term unwinding plays out, one structural fact remains. Millions of everyday investors in China who previously had an easy, low-cost way to speculate on gold through paper contracts no longer have that option. If they want exposure to gold going forward, many will turn instead to physical metal or to gold-backed funds. Over time, that shift can steadily increase demand for real physical gold, even if it does nothing dramatic to the price on any single day. This is the part of the story that often gets lost in the noise. Short-term pressure and long-term tightening are not contradictions. They can happen in sequence or even at the same time without canceling each other out. A market can experience real selling pressure in the coming weeks while also building the conditions for tighter physical supply months or years down the road. Treating this as a simple yes or no question, bullish or bearish, misses what is actually a more layered and more realistic picture. There is also a quieter signal worth noting. Sentiment across the broader gold market has been unusually low in recent months, with investment funds seeing consistent outflows rather than inflows. This matters because a genuine supply squeeze typically requires large numbers of everyday investors actively trying to buy physical metal at the same time. Right now, that level of enthusiasm simply is not present, which suggests that whatever happens around July 24th, an immediate, dramatic shortage is unlikely to appear overnight. What this really points to is patience over prediction. The forces being described here, reduced paper speculation, steady central bank buying, a slow shift toward physical ownership, are the kind of forces that build pressure gradually, not instantly. They are far more likely to matter over the coming years than on any single Thursday in July. In the final part of this video, these threads come together into a single, grounded conclusion, one that moves past hype and speculation and focuses instead on what serious, long-term minded investors should actually be watching in the months ahead.